It's a bad day for the market, but not out of a range. You seem to be saying there's no reason to believe that stocks are falling out of bed here.
Well, first, great to be with you, even though it's an ugly day. I think the big picture is right. This market has been churning. It's been a split market below the surface. Our overall theme for this year was a bull in a China shop. We think the primary market trend is up, but we thought there would be some disruptions. And if you go back to November, initially the market was focused on all the potential positives as far as deregulation and taxes. And back then we said, coming into this year, we think the market would start to focus on some of the other side, such as tariffs. And I think in the short term, the market's a little bit heavy here. There is that kind of a little bit of a growth scare with some of the PMI services numbers this morning, the Walmart numbers, consumer sentiment. So I think we are going to be in a choppy period. And don't forget, in March, we're going to start getting some of this event risk around tariffs and the debt ceiling battle. So all in all, I think we likely have a little bit more downside here, but that's in the context of a bull market, in our view, that's still intact.
Okay. Bob, Friday Bob, always good to have you here on set, especially on a Friday. Growth scare in a couple ways. Growth stocks took it on the chin, particularly today. A lot of the larger tech names weren't hit as bad, but it was NVIDIA, Tesla that were kind of growthy. But you think there's also a global growth challenge here?
Well, I think what we're basically seeing is the market's starting to recognize that the euphoric expectations that were built into the prices that we're seeing may not come to fruition. And all this belief of this being the most pro-business administration that has existed in the post-war period is starting to be questioned. Why? For good reason. If you look at the actual policies that are being pursued, the priority is tariffs, decreasing immigration, and cutting spending. And all three of those things will lead to hits to nominal GDP. And if there's one thing that stocks don't like, it's hits to nominal GDP. And so we're just starting to see some signs in the data, but the big tightening effect is ahead.
So in light of that, I mean, we saw a very defensive tone to the market, Bob. I'm looking at a 10-year Treasury yield at 4.429%. You actually saw consumer staples finish higher in the S&P today, and utilities basically flat, again, speaking to this defensive tone in the market. Is this the right way to be approaching positioning right now, given the fact that there is this growth scare shakeout happening, or is it overdone?
Well, I think the big question in the market is where is the mispricing in terms of the expectations? And if you look at something like the Mag 7, they have relatively high earnings expectations, but they're actually expected to slow their earnings over the course of the next couple of years. It's really a story outside the Mag 7 where you see earnings expectations are pricing in an acceleration. So hopes that either AI is going to deliver incredible benefits or that the U.S. economy is going to power forward in this pro-growth administration. And I think there's a lot of questions about whether that's really going to come to fruition. One of the most interesting things is we're starting to see those 25 year-end earnings just in the last couple of weeks start to come down in terms of the expectations. So it's possible we're seeing a turn in that sentiment in the market.
Keith, I want to get your thoughts on this, because are there buying opportunities when you see major averages down as much as they were today? I'm looking at the screen right now. We basically closed at session lows. S&P down 1.7%, Dow down 1.7%, but the Nasdaq down more than 2%. Russell 2000 down almost 3% here to finish the week. We're talking about the growth scare. You also had soft economic data this morning, most notably the Michigan sentiment numbers, options expiry, and as Mike Santoli has pointed out, this 5-year anniversary of the market peak pre-COVID, just the fact that we're lapping 5 years in a couple of weeks here on COVID. What are you watching as you do have this wall of worry now for investors?
Yeah, well, I think it's a little bit premature to say there's a lot of great buying opportunities. If you remember, we just hit an all-time high on Wednesday. And when you look below the surface, small caps actually now about 9% below where they were right after the election, making fresh relative lows. We still like technology long term, but I think that kind of corrective period likely has further to go. And as I mentioned, you have a lot of event risk heading into next month. So I think the market likely will present a better buying opportunity, a bit lower from where we are today, that will present a better opportunity. I just think, again, 2 or 3% from an all-time highs where valuations were and kind of where sentiment got a bit complacent. I think we're just a little bit early to say that. But you have to also remember, this market is often 2 steps forward, 1 step back. And I think we're kind of in that 1 step back period right now. That's probably somewhat early in that step back.